everyone. I'm Rick Bensignor. Today is Tuesday, April 26th, and welcome to this week's In the Know Trader Show. Well, as we record late Tuesday morning, we got the S&P down about 78 points. That's 1.8%, another real bad day for the market. NASDAQ's down over 3%. The Dow's down 1.5%, so not nearly as bad. U.S. 10-year Treasury rates falling another 9 basis points down to 2.74. That is about 20 basis points in 2 days since the highs we made last week. Crude oil is up a little over $2. Natural gas is up 27 cents, barking on the door of $7 per British thermal unit. Bitcoin's down $1,100. The dollar is on its another new high for the move. It's now over 102 when we're looking at in terms of the US dollar index. And despite the strength in the dollar, gold is up about $10 today, getting back about a third or so of what it lost yesterday. So that's a look across the markets. Let's take a look at what we're going to discuss in today's show. In the trader education portion, we're actually I'm gonna walk you through the brand new In the Know Trader website. I've been talking about this for months. Unfortunately, it has taken I will even say, ridiculous amount of time for programmers to get things right. I had a company build it for me, and it has just been a mini nightmare. But the good news is it's done. Everything's good. I'm going to walk you through the site and show you a whole bunch of changes we had from the prior site and all the products we have, etc. In the market overview section, we'll take a look today at the VIX, the Diamonds, which is the Dow Jones tracking ETF, Dow Jones Industrials, and the US 10-year. And then because we didn't have enough time last week, we're going to stay and redo the technology sector as our sector focus. We only got to a couple names last week, especially given the fact that we've got earnings this week affecting several of these names. We'll walk you through the charts, and we will make sure we get through all of them this week. To sign up for the In the Know Trader Weekly ETF Tactical Trader Report or the 7-Eleven Monthly Spider Report, go to the brand new intheknowtrader.com website. The weekly ETF report generally comes out Thursday evenings, and what we do is go through a full macro background of things going on across all the markets that you need to know. So we're talking about U.S. Treasury rates, credit spreads, the dollar, key commodity markets, and a deep dive into the S&P. We then give you a brand new trading ETF idea for each week and walk you through and go through every single open trade we have, including charts and updates to stop outs and targets if they change until we are out of that trade. As far as the 7-Eleven monthly report, this is a report I started in August of 2020. It is designed to outperform the S&P by being in anywhere from 5 to 7 the 11 macro sector spider ETFs that exist, for instance, the XLE, the XLK, the XLP, and so on. There are 11 of them. All 11 combined give you the return of the S&P. It's just components of the S&P 500. What we do is try to pick no more than 7 in any given month to outperform the S&P, and you can see the results in front of you. In March, we outperformed by 20 bips. Year to date, through the end of March, we are up 1.71%. In our fiscal year, which started August 1st of last summer, we're outperforming by 262 basis points. And since August 1st, 2020, we're outperforming by 616 basis points through March 31st this year. That is honestly an incredible figure, something that less than 1 in 7 can do over time, which is to outperform the S&P and outperform it with numbers like this. You know, if you outperform the S&P by 2 basis points over 5 years, you still are considered outperforming the S&P. This is 616 basis points in 20 months. So if you are interested in that report that comes out monthly, go to intheknowtrader.com. And again, we'll show you that shortly. I wanted to look at, instead of year to date, which we often look at, let's take a look at the sectors month to date, because you're really seeing some big rotations and things that are different than what we've seen over the last several months. For instance, technology and communication services continue to underperform. That's not different. But what is different is that energy is underperforming. It has been a stalwart outperformer. And year to date, it is still well outperforming the market. But this month, it is down on the month. It's actually, I take it back, it's not underperforming because the S&P is down more than energy is, but we actually have a negative month for energy, something we have not seen in a while. And staples is by far the best performer this month, up almost 5% on the month, and that's 10% better than the S&P is. So clearly we're seeing, take a look, healthcare down, but outperforming. Utilities down on the month, but outperforming. Financials, which is, of course, we've talked about, is the canary in the coal mine where something was very wrong there. Financials not only down on the month, but actually underperforming the S&P. That's with interest rates still 100 basis points higher than it was just about a month and a half ago. So that's been the big surprise, and something that we've actually adjusted recently in the 7-Eleven portfolio. And real estate, not only outperforming, but outperforming by almost 7% to the S&P. So you're seeing a pretty decent shift to, again, a more defensive market, which makes sense. We know the AAII poll shows that individual investors are very bearish, almost historically so. The last week's numbers, we'll get a new number tomorrow, but actually 2 weeks ago, it was the numbers were the lowest since 1992. So 30-year lows in investor bullishness. So the bulls jump on that as a contrary opinion indicator, which it usually is. And we know historically at the turns that individual investors are almost always wrong, but they've been right all year to basically be bearish, and they continue to be bearish, and you can't argue with the fact that we've been in a bearish market. So we know that there can be short covering rallies at any time, and the market could put in a bottom, but the way it's acting, it does kind of give you a sense that it still wants to trade lower. So just we're seeing the shift to a more defensive market, and it seemingly is the right way to be, at least for now. Understand that when and if things change, they could change very quickly. But for now, still the right way to look at things. All right. Let's take a look at, let me find my cursor here. Let's pop up the brand new In the Know Trader website. So, there's a very different look and feel to this to what had previously been there. The original site is something I built probably, 5 years ago or so, and technology's changed in building websites, and we've just made it much more up to date. The homepage essentially gives you everything about us, the mission, the fact that my goal here is in all the In the Know Trader products is to get you to trade alongside the pros instead of against the pros. And you'd be surprised how many people in the industry have you positioned. If you listened, you subscribe to their newsletters, listen to them on podcasts, webinars, etc. How many of them actually have you consistently positioned against what smart money is doing? They don't have the tools or the know-how to do what we do with the 40-year experience that I have in understanding market movement, being an expert in behavioral finance, and understanding when the bulk of people are positioned incorrectly for the new upcoming move. We, of course, offer, besides our written products, we do coaching for traders, for financial advisors. That is actually, almost every week we get several new people asking to be coached. So there's information you can find out about there, all the products we have, and of course, contact us. So the basic page. When we go to the about, this gives you the information if you have any question about the pedigree I come from in order to provide the advice I do. You can see I am formerly Morgan Stanley's chief market strategist. I was Wells Fargo's head of cross-asset trading strategy. When I was at Bloomberg in the late 1990s, I was the head person in the firm for everything that had to do with futures markets, commodities markets, and technical analysis. And I'm the person who designed Bloomberg's charting system. Previous to that, I was a 12-year member and floor broker and independent trader of the New York Futures Exchange, COMEX, where they trade the precious metals, and the Coffee, Sugar, and Cocoa Exchange. And additionally, I was the first to teach and write the course on behavioral finance theory at NYU. Obviously, I have my own book out in print, which was called New Thinking and Technical Analysis. It was published by Bloomberg Press in October of 2000. There, I went to 12 of the best technicians I knew and had them each write a chapter on one of their favorite models and how to best implement it into your trading strategies. And I wrote the chapter on the futures markets for Investors Business Daily's Guide to the Market. So that's my pedigree. And I bring that up solely as a reference point to what so many other people do who write market newsletters, which not only couldn't come close, but the reality is most of them, and whether you come across them on social media, which is where most of them advertise, they don't have any credentials. They're generally salespeople. Occasionally, it's a financial advisor, and some financial advisors are really smart about the market, and some, frankly, were nothing more than asset gatherers, and they're salespeople, and they really don't understand markets much at all. So I advise you to continue to look for people who have the right background, market knowledge, and expertise, and who actually traded the market significantly. And I don't mean occasionally doing something in their personal account, but literally, I traded 12 years in the commodity pits. I've been a trader for over 30 years on Wall Street, jobs employing me to be a trader and tell others how to trade. That's the background I come with, and I suggest that any other person that you consider listening to has a similar background, enough so that what they say actually makes sense. I see all the time on social media people who you've never heard of telling you about some algorithm, and look, we told you to buy it here and sell it there, and it looks perfect on a chart. Well, anybody can just tell you that and film themselves saying, here's where we would tell you to buy it, and here's where our model would tell you to sell it. It's meaningless. And I'm amazed at how many people get suckered into buying these people's products. So what I can tell you is do your homework. Don't simply buy because somebody's got a slick ad or a pretty girl there hawking a particular product. You're going to lose money. As far as our services, 3 different choices from written subscription. The weekly tactical trader report, I already told you what that was. If you select it, you have a choice of going month to month, in which case you can cancel anytime and only pay through the most recent month that you've been charged already, or you can go annual. And if you go annual, here, just to show you quickly, it's $129 a month. You get a free 7-day trial. We don't charge your credit card for 7 days. But if you go to an annual, it's $1,188 a year, which is the equivalent of $99 a month. So you save $30 a month when you sign up for an annual subscription. You get the same 7-day free trial, but after 7 days, in order to get this type savings, which is substantial, it's not cancelable until, well, you can cancel at any time and your service would immediately stop, but there are no refunds. So for those of you who are confident in who I am, what I do, and the work I've done, most people end up signing up for the annual because of the consistency of the work I do and the fact that it is substantial savings. Besides that, you can go to the monthly 7-Eleven report. That also has two-tiered. You can go month to month, and if you go month to month, it's $87 a month. If you choose to go annual, you pay a one-time fee of $888, again, with a 7-day free trial, so you can cancel within the first 7 days. But the $888 is equivalent to only $74 a month, so you save $13 a month by going annual in that monthly report. And then lastly, we have a package where you could subscribe to both products. And if you subscribe to both products, you get even better savings. Month to month goes to $198. But if you go to the annual year, it's the equivalent of $158. So it's a one-time payment of $18.96. You get both products and you have substantial savings. So those are our written products. The only other thing we have, again, is trader coaching, same type thing. You can go for just a 1-hour coaching session for $297 for the hour, or if you do 3 sessions, it's $799, saving you basically $100 when you sign up for 3. The media page, I want you to pay and spend time on, pay attention to and spend time on, because, and this is just slowly loading here because we've got so much in here. What I've done, and actually I was just interviewed again this past weekend, so we'll put up the most recent Correlon Economics report. This is a radio show. It's available Saturdays. If you go to kereport.com, they interviewed me for about a half hour, and every month they interview me, so you can listen to past episodes as well as the most recent. I'll put that up later today. I had been interviewed multiple times from Real Vision, so there's some really good interviews here to watch, including the toolkit to be a better investor. And then I've got every in the know trader show like we're doing like this that StockCharts produces, and we've got everyone from the year up here. So each week we put on, the most recent one. And I tell you that there's over 130 in the know trader episodes available on YouTube and StockCharts.com. So you just have to go put my name in, or in the know trader in, to YouTube or on StockCharts, and you will get your pick of many episodes that I teach you things about be a better risk manager, how to play the market better, how to be a savvier trader, etc. So those are all here now, nicely put together on the page. So that's the new website. I hope you spend time on it. I hope you enjoy it. I hope you sign up for our products. And that's that for this week. Now, let's get to charts. We're going to start off with the VIX. The VIX is moving up as we speak. It's just about at 31. We had clients go long the VIX, either as a tradable. There are ways you can play the VIX. It's no pure way. Many people will use VXX. I caution you, if you use VXX, understand what it is. It's an ETF, but it does not track the outright price of the VIX. So you really have to understand it, or you will lose money with it. But the other way to understand and really incorporate knowing when volatility is going to change direction is for those of you who trade options, and knowing when options are cheap and options are expensive, and when that is likely going to change from up to down in the direction of the VIX is really important, so you know whether or not you're buying options or selling options. And of course, if you know about the options market, you know you can buy options for a bearish position. That's called buying a put. You can also buy a call, which is a bullish position. And you can sell a put, which is actually bullish, or you can sell a call, which is actually bearish. So knowing where we are in the VIX structure is really important. And we got clients to buy this literally the day that the VIX made the low against the trend line from last November's lows. At the same time, it printed an aggressive combo 13 signal that nailed the low. We stalled against, this is a daily chart, we stalled yesterday against the propulsion exhaustion level. We're pushing through it again today, though. If we close above 30 and change and open higher tomorrow and take out today's high, so that's a multi-factor kind of filter, then it's suggesting much higher VIX prices, not just to the 34 level, not just to where we had the triple top earlier this year, but it would actually suggest that we make new highs and take out the triple high, which was against the January, the late January high from 2021. So that would also take out last year's. So, we're kind of on the cusp here of what would imply, if we got a VIX that moves like that, that the market still would have substantial room to come down. So just something you really need to pay attention to, especially if you're in the option place, but in general. Let's take a look at the US 10-year chart. And this is also really important because we told you a week or two ago that we were getting an offsetting signal for exhaustion of uptrend in yield terms. This is the TNX chart, to the same signal that was made on the all-time low. So we had a TD combo 13 signal on the low. We finally got a TD 13 signal now. I have to tell you, as best as I can tell you, that is why we were pulling back. Institutional traders who know this model are leaning into the yield rally, which means they're now buying bonds. And they're buying bonds also because the market's coming off. So you've got a flight to safety. You're already seeing that in the US dollar, trading over 100. People are in love with the dollar. And even with rates pulling back, people are in love with the dollar, although I think we're getting closer to a potential end in that move. But this is something we showed you a couple of weeks ago as a reason why you did not want to first be selling bonds that you owned at that point. We actually told you in these webinars that in the summer of, it was last summer, against this setup 9 count, I told you I personally sold out of virtually every bond I own, and had totally hedged my bond portfolio, looking for higher yields. And obviously this is the move we've had since then. And then let's just quickly take a look at the Dow before we get to some of those individual charts. So here's the Diamonds. This is the DIA ETF. There's a weekly chart. We have broken beneath the uptrend from this year's lows. We're still above those lows. So, not all hope is lost in Dow terms. Actually, I'll just quickly show you the Qs. The Qs are coming out of the bottom of their cloud. Now, the lagging line in the next week or two, if we fall any more, is going to start hitting the top of its cloud, which is potentially some support. But the Qs remain looking. Look at this chart and the price action of bottom of the cloud to top of the cloud, coming out of the bottom of the cloud versus Diamonds, which only went from the middle of the cloud to the top of the cloud, and it's still in the middle of the cloud. So obviously the Dow is significantly stronger. Oh boy, once again, we're down to just a couple of minutes. I'll try to get through as many of these tech names as I can. Let's start with Apple. Again, most of these names are reporting. These are all going to be weekly charts. Still within the trading range that we have for this year. So, double top. We don't quite have a double bottom yet. It's still a heavy looking chart. You need multiple Friday closes above 167 or so for this to be bullish, and it needs to be done in the right way. It has not been done in the last month that way, and that's why we're still not there. And even there, we're on a 12 count towards the 13. Look, this is distributive. I hate getting out of a name like Apple, but it's not a great looking chart. Microsoft, another one about to report. Looking very much like the Qs, just about towards the bottom of its cloud. If it comes out, I'd look for this to get down to 250-ish before you potentially have the next support level. Lagging line is beneath its baseline. That's not a good looking chart. So all you have left really are these lows, this year's lows. If we come out through here, I suspect that's a worse looking picture. NVIDIA. Same thing, another tech name right on the bottom of its cloud. Lagging line is just poking through its baseline. This too, if it falls, not much to hold this up until it gets to the 150-ish level. So significant downside targets if this breaks. Visa, pure sideways. just barely maybe coming out of the bottom of its cloud. If we get any big whoosh down, that puts that into essentially sell territory, and I'd be concerned. Mastercard, a little better than Visa. So as a pair trade, Mastercard looks better. Broadcom, AVGO, healthier looking than any of the other ones we've seen. This is well above its cloud. So as a pair trade, you find a natural pair to that. This is a better looking chart. Cisco, similar, closer to the bottom of its cloud. So other ones in this group are better. Not going to be able to get through all. Adobe already has, it's broken. This looks quite weak. I don't really have any downside targets here until 294. So this is not a pretty looking chart at all. And I'll do one more. Let's pick AMD. AMD on a 9 count, the only one we've seen that's on a 9 count with support in this range. Now it's a wide range here. It goes anywhere from about 84-ish down to 74-ish. But in there, if you want to do a little bottom fishing, that's the place that you can consider doing it. If it comes out through the bottom end, though, that's trouble. That's it for this week. I hope you enjoyed the show. I hope you enjoy the new website. I'm Rick Bensignor. Thanks for tuning in to In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.